This is a real scenario. Her current financial advisor told her she should distribute the $900,000 from her taxable IRA and put the money in annuity to have guaranteed income during retirement.
That was one of the craziest things I ever heard in my life. But like, here's the thing. Guns aren't bad either. But the issue is most people that have them shoot people. People try to be like, oh my gosh, like annuities aren't bad. Like, okay, that means that you're probably an insurance agent. Sorry, you're a one-trick pony because you don't have your investment license and you're trying to force fit something on a client that doesn't make sense. Kudos to everybody who is an insurance agent who does it right. But me being in the industry for over 15 years, I can tell you that most of them don't.
I don't know if it's ignorance or negligence, but
both. What's up, everybody? Welcome back to another episode of the Melanin Money Show, Expert Edition. So just for those of y'all who don't know, the reason why we decided to start doing these is because we get asked a lot of questions, whether it's in comments, DMs, carrier pigeon. You know what I'm saying? We said, how can we get these questions answered, right? And so, every other month, we host these live workshops where people who are interested in potentially working with us, they get to access their questions on the spot, right? So this is what this format is designed to do, answer your questions. So if you got questions, either one, drop it in the YouTube comments, or two, come to our next workshop and get an answer live. But until then, let's answer some of the questions that we got most recently.
Yeah, and guys, we haven't reviewed these questions. So there's going to be live questions. That's how you know our expertise is... It's either gonna work or it's not gonna work.
Either way,
we're gonna find out together.
We don't got time to edit because we got. As y'all can see, like I'm ready to go. Outside on rooftop. So it is what it is.
Okay, let's do it. Ask and advise. Okay, so, okay, I got this question. Remember this question? You're gonna remember this from the workshop. So, this individual has about $900,000 in retirement savings. Mm-hmm. Her current financial advisor told her that she should, and she's 2 years away from retirement.
Okay.
So $900,000, and one of her accounts has $900,000 in it. She's 2 years from retirement, and her current financial advisor advised her to make distributions from her IRA of $900,000 and put all that money into an annuity, so she can have guaranteed money during retirement. You don't remember this question?
I remember.
Okay,
yeah, I remember that. But what was the actual question? Should she do that?
Should she do it? And guys, we heard this is a real scenario. From a real person.
Yeah.
Her current financial advisor told her she should distribute the $900,000 from her taxable IRA and put the money in annuity to have guaranteed income during retirement.
That was one of the craziest things I ever heard in my life. Right. So correct me if I'm wrong. Carter's a tax guy here. That would cost about $423,000 factoring in the penalty?
Oh, 10% penalty, yeah. About $300,000+, maybe $400,000. $300,000 tax bill, maybe $100,000 penalty.
Yeah. So we're looking at $400,000+, right? Mm-hmm. Just off the rip when she decides to distribute the money from her taxable account. Yeah. Insane. That's bad recommendation number one. Then number two, to add insult to injury. To add insult to injury,
I didn't even look at it as a
as a part. Yeah, that's step one, right? To add insult to injury, she said, "Hey, let's lock this. We just chopped your money in half. Let's lock up what you have left, right, inside of this annuity." Now, again, I saw y'all in the comments on Instagram, but here's the thing: guns aren't bad either. But the issue is most people that have them shoot people, right? So people try to be like, "Oh my gosh, like annuities aren't bad." Like, okay, all right, that means that you're probably an insurance agent. Sorry. Who you only have one, you're a one-trick pony because you don't have your investment license and you're trying to force fit something on a client that doesn't make sense. And again, kudos to everybody who is an insurance agent who does it right. But me being in the industry for over 15 years, I can tell you that most of them don't. And so putting that money in annuity now reduces all flexibility. It locks up the money. And if you do decide that there's something else you want to invest in, like, oh, I want to buy this real estate property or I want to buy this business, guess what? The penalties associated with trying to get premature withdrawals from an annuity contract are ridiculous, right? So that is a double-edged, terrible decision. Now, what she should do, she's a couple years from retirement, if anything, she should roll that money over into an individual IRA first, right? That way she's, number one, saving on fees because most 401k plans have high fees, right? And they have limited investment options. So y'all, if you don't know what to do, it's okay to do nothing for a second.
Yeah.
Right? It's okay to do nothing. This would be an in-kind transfer, a non-taxable event. You have less fees and more options that you can invest until you decide what makes the most sense. Now, when you have that money in an IRA, then relative to your retirement income needs, relative to your risk tolerance, we can decide what is the best move. Should I go, you don't need to go self-directed, but should I be able to leverage the money to buy a real estate? Do I want to buy a business? Like, we can decide at that time what makes sense. But what we don't want to do is cut our money in half, then put it in something that has zero flexibility, right? Before knowing what our actual goals are from a cash flow standpoint. Now, here's what I can say. Assuming he's a halfway decent advisor, he may have made that recommendation because the annuities claim to fame is the income that you get, right? If you follow the 4% rule, you're probably going to get less income from your retirement account, right? But that comes with also more flexibility and options. So he probably said, even though we're going to cut your money in half, you'll still have decent income, but that does not make it a good decision. So I'll put a bow on this by saying this. Let's reverse engineer what your desired goal is, right? What do I need the money for? How much do I need in retirement? Then we can decide the best place to put it. What I can guarantee you is not rolling it over and then getting half of your money and then locking it up in an annuity. That part we're clear on.
Yeah.
Okay. That was crazy. I'm still mad about that.
Yeah, that was.
I want your badge number for your license number, right? I'll report you myself.
Reporting myself. I don't know if it's ignorance or negligence, but
Both.
You know what I don't want?
What's that?
Another conference that people forget about by Monday.
Well, the good news is this ain't that. People gonna leave Wealth Weekend with the structure, the strategy, and all the secrets that have been kept from them for far too long.
And a team that'll help them implement those strategies, right?
That part.
Right. Oh, there go my ball. You see, this is what happens when you try to rush the process.
I'll tell you.
I'm gonna take it slow. Nice and slow.
That's much better.
You see, it's not just about force, it's about having the right form.
So I've been trying to tell you the whole time, and that's exactly what we're gonna show people, is how to have the right form at Wealth Weekend when it comes to wealth building.
Well, make sure you're in the room with Wealth Weekend 2026 so you can get the right form to building your wealth.
insane. First question is for you. Can I do a backdoor Roth IRA if I already have a Roth 401k with my employer?
The short answer is yes, you can, right? So with your employer, there's going to be contribution limits for that particular account, but your Roth IRA is an individual retirement account, so you can contribute to both of them. This year it was what, $7,000? It still was $7,500.
$7,500 for Roth, $72,000 for Roth 401k.
72?
72. I mean, it's if their employer
yeah.
matches. 24,500
Okay.
just for employee contribution, but they can match obviously.
Yeah. So on the employer side, you can take full advantage of that. And just for the benefit of those watching, the reason why people are very attracted to the Roth IRA or the Roth 401k is because once the money goes in, it grows tax-free and is distributed tax-free. So you go ahead and pay the taxes, get it out the way, so that when you're on a fixed income in retirement, you no longer have to worry about paying any taxes. And so the short answer is yes, you can do both. And on top of that, if you leave your employer, there is no limits on how much money. Well, you won't have to convert it because it's a Roth 401k. And so you can roll that money over into your individual IRA should you decide. That will not be a taxable event. And then when you retire, all that money you'll have access to tax and penalty free.
Yeah, and for those of you who are asking, what is a backdoor Roth IRA? It's a very simple strategy that allows high income earners. I think it's single if you're earning over 140,000. You're not allowed to contribute to a Roth IRA because the IRS says you make too much money. So the way around that ridiculous rule is there are limits on Roth contributions, but there's no limit on Roth conversion. So what you do is you open a non-deductible IRA at any brokerage account. Just call them and say, hey, I want to open a non-deductible IRA. Once they do that, you then fund the account the same day with $7,500, and then the next business day you call them back, say, "Hey, John, you remember that non-deductible IRA I started yesterday? Yeah, okay. Can you convert that to a Roth?" He's gonna be like, "Of course." They convert it, and then you invest the money after it is converted. You don't invest the money before because if the investments go up at all, that's going to be a taxable event. So you open the non-deductible IRA, fund it, convert it to Roth, then invest it. And
that's a very important nuance. Small, but important nuance.
Yeah,
for sure.
absolutely. Okay, so that was your question. Mine is, my CPA said I should change my election to a S Corp, but he filed Form 8832 to do so. I think this is the wrong form. And when I called the IRS, they let me know that my LLC has not been changed to an S Corp. I think something went wrong here. Can you help me? Can you help me? It's crazy. Yes. So I see this a lot. I actually saw it for the first time when I was a business manager for musicians and writers when I was living in LA, and it was these things called loan out companies. All a loan out company is basically an S Corp for writers and creators, right? And so I used to have to do a lot of conversions from LLC to S Corp. I saw that somebody's previous CPA, just like this person's CPA, filed the wrong form,
Which is crazy.
for the S Corp election. And it's a common mistake, but it's too big of a mistake to be making at this level. So the difference is Form 8832 is how you make a C Corp a S Corp. So if a client started out with the C Corp and then they filed Form 8832, then that would make that C Corp have S election status. However, when you have an LLC, it is Form 2553 for you to convert a LLC to an S corporation. And if you have an LLC and you give the IRS Form 8832, it will not work because that is the wrong form for that. Because they're going to look for a C Corp. It's not a C Corp there. They're not going to be able to convert it. So I've seen this mistake happen time and time again. And the worst part about this is, like, usually people don't find out the mistake until the end of the year, because once they file the form, they feel like, oh, okay, I'm an S Corp, but they're not. And then they miss out on all the tax savings that the S Corp was supposed to give them in the first place. So this is a really costly mistake.
You should fire your CPA.
You should fire your CPA, and please find another one, because that's going to cost you. But it's common, but it's cost too much.
But it would be common. It would be a commonly acceptable if an individual was doing it on their own. But if you have a CPA that's doing it, that's kind of table stakes.
Yeah, it's like saying a doctor, the patient dies. Like, yeah, it's like, bro, like,
malpractice insurance.
So yeah, okay, so if you're having somebody file an S election for you, I always recommend double check with the IRS 60 days later. And if it's not converted by then you know something probably went wrong. Okay, so this question is for you. I have an IRA rolled over from a previous job's 401k. Should I invest it? Should I roll it over into a self-directed IRA? What is the difference between self-directed and a regular IRA?
Good question. So a self-directed IRA sounds just like it sounds, right? You get the ability to self-direct the different types of investments you want to make, right? So, for example, in a normal IRA, you can buy stocks, bonds, mutual funds, ETFs, your generally traditionally accepted securities and assets. In a self-directed IRA, you can actually purchase things like real estate. You can buy cryptocurrency. You can even purchase a business, right? Now, that's amazing. The caveat to that, though, is it is still a retirement account in nature. So while you do have the ability to purchase alternative assets, any profits or expenses associated with the assets that you're purchasing must go back into the self-directed IRA. And anything that you're purchasing cannot be these prohibited transactions, meaning like, okay, well, yeah, I know that's a rule, but if I buy this real estate property with my cousin and it has some profits and we're 50-50 owners of the real estate property, he's just going to cycle back the money. No, don't try it. Like, just stop, right? So where this is a great fit for is if, as you're approaching retirement, maybe you don't have a lot of liquidity, but you want to start building up your cash flow producing assets now, the self-directed IRA could be a great tool, right? Because as you get closer to retirement, you'll then have these assets that you've been stacking that can produce cash flow that you will be able to benefit from once you reach retirement age. But if you are somebody who is trying to benefit from the cash flow or distributions now, a self-directed IRA is not the best fit. So that's the fundamental difference, is the type of assets you can buy. Versus the regular IRA, you'll be able to buy the traditional retirement account assets that you would any other time.
Great answer. So let's move on to a tax question. My company, this year, my company will gross about $3 or $4 million.
Good job, by the way, whoever you are.
Yeah, amazing.
We hold $1 to next Friday.
We're looking at about 50% profit margin, so $1.5 to $2 million in profit. Amazing. I'm still an LLC. That is crazy.
Wow.
And I'm looking to change my entity status because I feel like I have the wrong entity. You absolutely have the wrong entity. Would an S Corp be best for me or would a C Corp be best for me?
Question.
Great questions. First of all, whoever you are doing very well.
50% the good old days.
Yeah. $4 million top line, $2 million bottom line. That is a great place to be. And it seems like a sole owner. So should they go S Corp or should they go C Corp? This is actually a really good question because they're right at the line where like it's not a
because of their profit margin.
Because their profit margins is like either way. So let me break it down. So anybody earning over $50,000 in profits should be an S corporation because that is when the S Corp start helping you save on taxes more than it costs to maintain the S corporation, right? Because S Corps help you save on self-employment taxes. So normally I would say, most people should be an S Corp, but like at certain points, a C Corp could come into play. And the reason why a C Corp could come into play is because at the end of the day, if you have $2 million in profit, it's only so much that you can do. It's only so many tax strategies that you can do to wipe out $2 million in profit before the end of the year, right? So if you make $2 million in profit, you have it to December 31st. If you don't find a way to reallocate that money by December 31st, that means that $2 million will be hit at your 37% tax bracket, which is exactly, ouch, right? It's about $600,000 in just federal taxes, right? So why would a C Corp help you avoid this? Well, if you were to convert this business into a C corporation, you have to pay 21% corporate tax on that $2 million, but you could actually leave the money in the company and say, I'm not going to distribute it personally. So instead of paying 37% taxes, I'm only paying 21%. So that's a 16% net difference in taxes that you're going to pay for being a C Corp versus S Corp. It's 16% on $2 million. That's $320,000 in tax savings if you were a C Corp. So a C Corp will help you save $320,000 in taxes in this scenario. Now, what's the problem with that? Well, at some point, you're going to need to distribute that money from your company.
Right.
It might not be this year. It might not be next year. But at some point, you're going to want to realize some of those earnings. And when you take that money out, it's going to then be taxed again at your personal income tax rate. So you pay 21% on it the year that you earned the money. And then when you take it out, you're going to pay another 20, 30, 37%. What people end up doing, though, is say, okay, instead of taking a distribution, I'm going to take a loan to loan the money back to myself. And I'm going to spend the money personally. And that's smart. That makes sense. We preach on this channel, loans are not taxable. Borrow from your assets, borrow from your real estate, take a loan against your portfolio. The problem with taking a loan from your C corporation is you eventually have to pay that loan back with interest. And most people don't have the diligence to keep that paper trail and say, hey, I took a $500,000 loan from my C corporation. I'm going to pay it back $5,000 a month and at this interest rate. You have to pay that money back to the company, right? And most people just try to take these loans out of their C Corps, and over time, the paperwork gets messy, and the IRS is going to want their money eventually. Yeah. And so a C Corp could make sense if you have the diligence to do the paperwork right. But I would honestly say, if I had to give an answer, I would say still do S Corp because we at our firm still have strategies that can get rid of that $2 million profit through investing.
There we go.
Not by spending the money. We can get rid of that $2 million profit, or at least a good majority of it, with one strategy actually that we do in our company at the end of every year. So that's why for that point, I would say S Corp. Yeah.
Okay. That part. No, that's good. That was really good. Thank you for diving deep on that so that they could really get the context.
Okay. Last question of the episode. My job just recently gave me the opportunity to decide whether I want to be continue being a W-2 employee or shift to being a 1099 contractor. This is the first time they gave me this type of flexibility. I'm not sure what I should do. So, great question. And a lot of jobs are moving in this direction. And now that we have decentralized work, right? And so what is the difference between W-2 and 1099? Well, as a W-2 employee, when you sign up to work for an employer and you decide you want to go W-2, the good news is you're officially a salaried employee, which means you get access to health insurance, you get access to retirement benefits, and you get access to all the other company fringe benefits that they have. And so due to this, you have more stability and, it feels like you actually, work at a company where you can take advantage of all these benefits. Yeah. Also, it makes your tax situation easy because they take taxes out of your paycheck.
Yep.
So you don't have to think about it. They take taxes out of your paycheck. You get remaining. You spend it however you spend it, and you don't gotta think about it. And usually, if you do it the right way when you sign up to work with this employer, you won't have a tax bill come tax time. You probably get a little bit back depending on your situation, and that's how most people live, and that's fine. Now, what happens when you're a 1099 contractor? Well, when you're a 1099 contractor, it's basically your employer saying, hey, you work for us, but you don't have to solely work for us.
Yep.
And due to that fact, you don't qualify to benefit from any of our retirement benefits. You don't qualify for our health insurance. And we're not going to take taxes out of your paycheck. However, this gives you a lot more flexibility as the employee. Two things that happen here. Number one, your employer saves 7.65% on the money that they pay you. So if you make $100,000 and you shift from W-2 to 1099, they're going to save $7,600. So you can honestly ask them, like, hey, if I go 1099, are you going to give me that 7.6% raise of the money you're going to be saving? They're like, who told you that? And first of all, but they can give it to you, right? Or at least some 5%, whatever. So you can go from making 100 to 107. That's great. The second flexibility that you get is you now are a business owner according to the IRS. So all the tax deductions that business owners are entitled to, you now are entitled to.
Yep.
Home office deduction, vehicle deduction, travel, meals, cell phone, home office, Augusta rule, all these different tax strategies, you now are privy to being able to take. Now, the biggest pushback I get when I tell people, when I get this, people are like, well, what about retirement? Like, I don't got a retirement plan. What about health insurance? Well, calm down. If you're young and you're healthy, health insurance from the marketplace is not going to be that expensive, $300-$400 a month. But guess what? That's also a tax deductible expense for you. So this is what I did. Like when I had the opportunity, I went to 99. I got my health insurance from the marketplace. I got a high deductible plan that was cheap because I don't go to the hospital that much, which also let me get an HSA, which HSA allows me to invest in my health insurance account for one day and I get a tax deduction for investing in my HSA. Also, what am I going to do about my retirement plan? Well, if you're self-employed, guess what? You now can set up your own self-employed retirement plan. SEP IRA is super easy to set up. Takes 10 minutes. Or a solo 401k, it takes a little bit longer, but it's still your own retirement account. Yes, you miss your employer match, but you can still match yourself and have a lot more flexibility on how much you can contribute. So if it's up to me, I'm always going to 1099 because the money I miss in the match contribution from my employer, I make up in tax savings easily. And so that is what I would recommend you do if you have the option to go 1099. I would definitely go 1099, get that raise, take advantage of the tax savings, set up your own health insurance, your own retirement, and then you'll be good to go.
Boom.
Easy money.
Nah, those are some great questions. I love being able to, first we to dive deep and answer those questions. I'm sure many of you guys have questions like, man, I got a question right now. So you only really have two options. Number one, keep listening to these episodes. Or you can join us at our next workshop where we do it live. We'll make sure that the information is somewhere around this video.
Yeah.
So you can grab a ticket and we'll see you there, or we'll see you on the next episode.
Peace.